Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Hello and welcome back to the Australian Finance Podcast. I'm your host, Kate Campbell, and today I'm joined by my co-host, Owen Rask, who is also our Chief Investment Officer at Rask Invest. Owen, welcome onto the show again.
That sounds very formal, Kate, and thank you for having me on the program. But not lawyer Kate Campbell, I might add. So no, it's great to be here and great to be doing this update.
So this episode, we try and do once a month to just give everyone a feel of what's happening in the market at the moment, and not the farmers market, the investment markets around the world, because we see so many headlines in the news. There's TikToks, there's YouTube videos, your friend sent you an article saying the share market's crashing, but what does it really mean? And do you need to action any of it? So most of the time, there's no action points to take away. You don't need to change something with your portfolio, but we just want to give you a general sense of what's happening, why is it happening, and what does that mean to you as an investor? Because that can be quite tricky to work out. You see these headlines and wonder, well, what does that actually mean to me? What does that mean to my grocery bill? What does that mean for my portfolio and the way I plan for my financial goals? So that's what we're trying to unpack today, Owen.
Yes, it is. And every month we bring you this update to cut through the noise, as you said. We give you one educational bite that comes at the start of the episode. And then we talk about ETFs. We talk about investing and what it means to you. And even today, for example, we'll talk about one of the strategies or the portfolios that I manage, which is called Jupiter, which is our high growth strategy. And we'll go through that. And you can see how these things play out and why things might happen in that. So hopefully you can use that as an illustration of maybe what it means to you and how you might think about investing. So that's about it, Kate.
Yeah. The first thing I wanted to talk about today, and I should mention we're recording this on the 15th of August because we're going to mention some numbers today. So this stuff's really dynamic. It's changing all the time, but we'll give you a general sense of what you need to know, and that sort of stuff stays the same. But I wanted to talk about emerging markets because it's something that we don't discuss that often, Owen, but it's actually part of our ETF portfolios here at Rask Invest. And now that we're talking more about how we invest and build portfolios, we're getting more questions about, well, what are emerging markets and why might I invest in them and why might someone not invest in them? So I thought we should spend a little bit of time today before we jump into what's been happening in the market this month, just sort of giving people an overview of what emerging markets are and why people invest in them.
Yeah, sure. So many of us have traveled to wonderful places in Asia or South America or maybe even Africa, different parts throughout the world. And we're familiar that with what I guess identifiers we use when we talk about things like first world or developed world, emerging or kind of third world is how some people might think of them. Frontier is another thing that you'll hear tossed around. So basically in order it goes developed economies at the top, which are the ones you know of, like the United States, a lot of Western world, these types of things. Then you've got what's classified as emerging markets. And that's kind of the next layer down. And these might be economies or countries that are growing fast, but haven't got maybe property rights, the really robust financial system, the social security, these types of things. And then the frontier markets are the ones down the bottom. And these are the ones that are, when I say bottom, not in a derogatory sense, I just mean it in the sense of how you can think about it in terms of like the further you go down, the riskier they might be if you're thinking about it through an investor lens. These might be countries that don't have a stable democracy, that may be in some sort of conflict, that may have different ruling partners, military coups, that sort of thing. And that's kind of like the spectrum that you get, Kate. And most of us just invest in Australia, either through ETFs, through our shares, through the businesses we run, or the properties that we buy. But a lot of investors and a lot of professional investors use the next tier down, which is emerging markets. And the actual name emerging markets came, I think it was the World Bank in 1981, wanted to create a subsidiary that would enable investment into quote unquote third world. So they created this thing called the Third World Fund. And the idea was that take some of the resources and the know-how and the money from the developed worlds to support the other countries further down. and allow them to flourish. But the idea of a third world fund didn't really gel too well with PR and trying to sell that to investors. So what ended up happening was they come up with this idea for emerging markets. And there's really been no true definition of what is or is not an emerging market. That's important to understand because when it comes to the ETFs that you might invest in, like the Vanguard one versus, say, the iShares one, those are two of the bigger index funds that track emerging markets. Those have different countries included in them. So depending on which one you pick, you'll get different countries in there. A good example of this is like South Korea. Is South Korea an emerging market? Like if you think about like what you probably, as you just think about South Korea, you probably say, no way. It's kind of like Australia in terms of like the rule of law, the technology investments, the society like issues that they deal with are very similar. Like it's not like what we would associate with something that we might go as like emerging markets, but that may or may not be included in the ETF that you pick. So there's no true definition of it. And that's really important. But the question is, well, why would you do it in the first place? Like, why wouldn't you just invest in the United States or Europe and Australia? There was this, we did an interview with one of Australia's kind of leading financial advisors. These guys by the name of Will Hamilton. Did this, of all places, I did this this discussion with him. It was an investors podcast from Noosa. And we recorded this in 2022, the end of 2022. It was a really interesting podcast that we did. And he had this quote, which I pulled out, which I thought was just like really interesting. So he's a financial advisor that deals with like a lot of wealthy families. And he said something like this: we think emerging markets represent 70% of global growth over the next 20 years. So when you think about that, if these countries that we're talking about are going to grow so fast, surely as investors, it would make sense that we would want to invest in some of those countries, not just the big ones like the United States, for example. And so a lot of people have this view. And there's another really fascinating one. It's from Jeremy Grantham. He's a real prolific investor from the US and a writer. And he said, emerging markets in many ways are the growth that's left in the system. They will guarantee to be growing faster than the developed countries. They're much cheaper. They haven't been beat up. They don't have as much speculative excess. They're a respectable investment. That was in June 2022. Now, when you hear people come out and say this, like one of the top financial advisors saying this, and then you hear this really famous investor say these types of things, you think to yourself, well, doesn't it just make sense that I would invest in that part of the world? And the answer is kinda. That's the answer. So depending on people's research, they'll have different opinions on whether it's really important or just like good to know, if that makes sense. Now, for us, we have quite a small amount of money invested in this part of the world because even though we hear things like this, like really bold statements, China's growing really fast, India's the new economy, these types of things, the data actually shows that these stock markets don't do as well as the developed markets. And you can go back over recent times or even the last 100 years. Now, some of them do well, where there's like rule of law and democracy, but many of them do not. And there are many reasons for that, Kate. But I just want you to be aware, if you're listening to this, having a lot of your portfolio in one of these places is probably more risk than you need to take. And even then, you might want to ask yourself, if it is actually necessary? There may be other ways to invest in it. For example, this is the final thing that I'll say, and happy to answer any questions. But with our investment portfolios, we invest in outside of Australia, the next biggest place that we invest is the United States, and we do that with the IVV ETF. And the reason that we do that, Kate, is not just because we get American companies, but we also get American companies that are growing around the world. Approximately, depending on the year, approximately 30% of the sales that are generated by the US companies in that ETF come from outside the United States. So like we're recording these on Apple iMacs, you and I, we're recording remotely. I've got an iPhone right here. It's buzzing a minute ago.
But people are buying iPhones in South Korea as well.
Exactly. Well, and they've got Samsung, right? Samsung is a big South Korean thing, and those products are sold throughout the world. So, consumers in the US are benefiting from Samsung. Google creates the software that goes in Samsungs. So, there's so many. It's more important to actually just look at not just which countries, but the companies and where they operate. And I think if you look beneath the data, you'll see that instead of trying to pick which of these countries is going to do really well, it might just make sense just to go where there's a lot of stable democracy. I know that's a bit of a contentious topic at the moment in the United States, but for the most part, stable democracy, really strong property rights, a culture of innovation, and this is really important, a really good relationship between Australia and the United States in terms of there's no trade war. If you put your money in a US company, yeah, you'll be taxed a little bit more, but there's a really good understanding between our countries. And so all those factors consider, what I would urge people to take away from this section is, yes, these countries are great to travel to. Yes, these countries are probably going to grow really fast. And yes, we probably should support them with our capital and our money, but we don't need to go all in on one of these types of investments. So prudent portfolio management is that you would have a small part, but not a large part of your portfolio invested in something like this.
And investing in an emerging market ETF can often be the only way to get exposure to certain countries' investment markets, because as an Australian investor, you often can't just create an account in different countries around the world and start investing in their individual companies, even if you wanted to.
Well, a good example of this, until recently, you couldn't actually invest in Indian stocks unless you were an Indian citizen. And so what a lot of people did, and what a lot of firms did, is they created like an ETF that would then invest in a firm or something that was locally owned and managed, and then that would invest in the Indian stock market. And there are various reasons why the Indian government would have done that. But the point is that, yeah, you're right. It's difficult. And then you've got to consider the tax implications. You've got to consider, even though we take it for granted as ETF investors, running one of those ETFs wouldn't be easy. If you think about, if you've got an ETF, say VGS is from Vanguard, really popular ETF, that has about 70 to 75% invested in the US, and then there's the 25% spread around the world, places all over, like Japan, Europe, whatever. If you think about it, for Vanguard to actually manage that ETF, deal with multiple legal jurisdictions, currencies, trading market windows, tax reporting, no wonder those ETFs tend to be more expensive. For example, the emerging market index ETFs, you might be surprised to hear this, but the really popular ones that I mentioned before, they often have the same fees as pretty much the active strategies. So there are numerous reasons for that, but basically, even though you might be going to one of these places to get this growth, you're going to pay more for it because it's more complicated for everyone. But secondly, this is a really interesting, we can do another podcast on it, but an index strategy, like investing in an index fund in those markets, may actually not be the best thing for you. And there is research to back this up through time. Sure, you could use those, but there may be in those markets other strategies that are not just index fund type strategies, like the ASX 200, for example, that may be better. But we can talk about that another time.
Yeah. So I guess taking away, have a look at what an emerging markets ETF is invested in, because it might be quite a different array of countries and companies to another one. So you want to figure out what you actually want to be invested in. We'll put some resources in the show notes so you can learn more about emerging markets and how financial advisors and investors think about them. And if you want to have a look at some of the Rask Invest portfolios, you can sort of see our explanation of how emerging markets are used in the portfolios there as well.
Yeah, I'm going to have one takeaway from today's episode. So stay tuned for that, and it will tie back into this point. So it's a very simple thing that you can remember. So if you're a bit overwhelmed by it, it's okay. Stay tuned for the action point from this episode.
Now, jumping directions completely, Owen, what is the RBA doing recently? Because that covers a lot of the headlines we see in the media.
Yeah, so we've done a lot of episodes on this on our Investors podcast, but also on our property podcast. The mighty Pete Wargent over on our property podcast. He's our stand-in guy for all things economics related, and he presents a monthly report to us and to myself So he writes that monthly report for our Rask core members, but also for our Rask investors. And you can read that. And basically, when Pete and I sat down last month, we talked about how the next inflation figure. So remember, inflation is the thing that is like how much your cup of coffee is going up from one year to the next. And obviously it's gone up a lot. Like everyone's noticed. Like I paid like $7.50 for a soy cappuccino the other day. And I always had a heart attack. I was thinking, I need to give up soy milk or something needs to change here. But that's inflation in action, right? The cost of cheese, the cost of groceries, the cost of electricity, like literally
the cost of broccoli at the moment.
Cost of broccoli, like literally everything is affected by inflation. Now you can have disinflation, which is where it goes the other way, but that's actually not healthy for a system, and that's a whole other thing. But basically, coming back to this month, what happened was, you may remember at the beginning of this year, everyone was like coping, like struggling. Like at Christmas, there was a lot of talk about like JB Hi-Fi is not getting as much in sales. Bunnings might struggle because not many people are renovating their house because they just don't have the money. Interest rates have gone up. We don't have the money to do that anymore. And then we moved into 2024, and what had happened was people were like, well, if people are struggling, interest rates will eventually come down to ease the pressure. But what happened was inflation kept persisting. Prices kept going up this year. So then all of the data was suggesting, oh, hold on a second, interest rates might even go higher than what they've already gone. And everyone's like, oh no, if that happens, like, I'm not going to be able to afford anything, which is totally fair. Everyone's feeling the pinch, at least everyone with a mortgage. Fast forward to last month, there was a lot riding on the latest data that was going to come out, because effectively it got to a point where people were thinking, if interest rates have to go up just to slow down inflation, that's going to have really big consequences for homeowners like us, Kate, where like we've been stretched a lot, right? Meanwhile, the older generation who tend to have more money and don't have as big mortgages, they're laughing all the way to the bank because all of a sudden they get an interest from their term deposit, right? So good for them. But for the rest of us that have a mortgage, we were struggling, and to be honest, have been struggling. And so it's been a different trade-off for us versus them. But what we saw last month was that inflation looked like it was starting to come under control. And that was really important for everyone. And so basically what happens when inflation comes down and the expectations for more inflation come down, what happens is everyone breathes a sigh of relief. You're like, oh, maybe finally I can enjoy my interest rates not going up on my mortgage. Now, notice how I said that there are two things there. There's the actual amount of inflation, like what was actually written down, but then there's the expectations of inflation. And that's what's changed in a big way. Even though you might read it and you might be like, oh, what's everyone talking about? It's like 0.1%. Like, what the heck? Why does that matter? Well, it wasn't that much of a jump. So that made people think, well, maybe all the steps that we've put in place are working. And that means in the future, interest rates won't have to go up. So that's what's basically happened, Kate. And a lot of people have taken that as really positive news. And you'll see that in just a second when we start talking about ETFs and the different price movements. But the RBA did come out and say that, hey, guys, hold on a second. Let's not get ahead of ourselves, because if inflation comes back in the next few months, we will probably have to increase interest rates. So you can understand my feel is that like most people breathed a big sigh of relief, but let's not, hold our breath. Like let's just remain prudent. Let's not get ahead of ourselves. And I can keep rambling, but that's the gist.
So you've got to keep on top of your budget still.
Yeah, you still got to have a budget. Definitely always have a budget, because the good thing about having a budget and being tight with purse strings is when times are tough, what it means is if you're able to save even $50 or $10 a week or whatever the case may be, if you're able to save something, when things do turn better, you've got a really good savings habit, but you've also got a little bit of money saved up that you can invest and watch it grow, while everyone else who wasn't saving wasn't able to do that. So that's kind of like your superpower, and it's real, and that's why we've said, for the last 2 years, Kate, you and I have said, hey, even if you can't invest $500 a month in your shares, maybe you could use a micro investing platform and still put $10 away. Just keep the habit. Keep the habit. That's what matters. That's more powerful.
And you can still call up your mortgage broker or your lender or send them an email and ask for a better rate, especially if you see some better rates available. It'll start to be quite competitive. You'll see different options. I sent a very simple email to my lender and got a small discount. I didn't go to all the effort of calling them. I wasn't quite in the mood for that, but I did an email and that worked.
That's great.
Well, it wasn't huge, but it worked, and it makes a difference.
Oh, everything. Why? Yeah, don't donate extra to the banks. Like, let's be honest, they got enough.
Yeah, so, I'm sure I could have worked a bit harder if I'd called them and looked at comparable rates and had done my research, but I was a bit time poor, so I just sent an email and got something rather than nothing.
Well, this is the beauty of, I'm glad you did that. This is the beauty of working with a mortgage broker. As everyone knows, we obviously have a partnership with Flint, which is run by Chris Bates, who you've heard on the podcast before. I'm currently refinancing. I think now's a good time for us to do it. And I went to them and I'm actually right in the thick of it. I should hear back from NAB.
How long does the refinance process take?
Depending on your situation, but like if you've got your, if you log into MyGov and you've got your personal income statement, which is in MyGov, you can click on the ATO section and it is automatically updated with all of your income from the year. If you go in there and it's up to date, that's what I'm waiting for. I just need the Rask group to there's been an issue
for
there.
Yourself.
Yeah, but yeah, I don't know what's going on, so the accountant's onto it. But if you go into MyGov and you click that thing, the ATO button, and then you go personal income statement, nowadays a mortgage broker can use that rather than pay slips to get you to prove your income, because that's the official record, right? It's with MyGov. So in terms of actually doing it nowadays, you don't, assuming that you've got like all your ID and your stuff's ready to go, you can just flick that off to them and you can hear back within a week, 2 weeks. Obviously, it might take a little bit of time, but it's quicker than when you buy a house, because then you've got the settlement period. You've got to wait for the quote unquote to get the keys and do all that. So, and that's a formal refinance. You can also just email them and say, hey, what's up? Give us a better rate and see what they say. That is instant. So, so that's worth doing. But yeah, I think that's a really good step you took, Kate. And it makes sense. That's the number one thing right now is people are paying more in interest than they have to. For example, just one final thing on this. The rate that we're getting looks like it's going to be 0.6% cheaper than what's advertised on the bank website.
It's quite substantial.
Yeah, so people that are just going to the bank willy-nilly and just be like, hey, can you give me a loan? Those are the types of people that pay the full freight. But if you actually do the research, you shop around or just get your mortgage broker to do it, chances are they can often get you a much, much better deal. So, and it's less stressful, to be honest. So, yeah. Anyway, should we move on with the movements in the markets? Or
yeah, I think that's a good idea. So looking at the investment markets around the world, and we usually do this by looking at some of the really common ETFs, so you can actually go and look at this yourself. What's been happening in the market recently, Owen?
So this ties in really well with the two stories that we've spoken about, emerging markets and also the changes in like inflation and interest rates expectations. So bear with me, but some people would have noticed over the past month, there's been a lot of selling up and down. As in there was a day, this is pretty jaw-dropping, even for me, someone who's seen this before, but there was I think it was a Monday in the United States a couple of weeks ago where NVIDIA, which is like the number one AI meme stock that everyone talks about and no one really understands what it does, but they just think they do.
Oh, you probably need a PhD to understand the video.
That fell 15% in one day. In fact, the Japanese stock market fell 10%. There was some wild moves. Australian bank shares fell like 4 or 5%. That's big, right? Like that scares the bejesus out of a lot of people. And what was really interesting through all of this is that the bond market, so the bond ETFs actually went up, which they did exactly what they were supposed to do. So how's that?
They don't always.
So what we saw over the month, Kate, was we saw over the past 30 days, this is just the ETF share price. The NASDAQ ETF, NDQ from BetaShares, full disclosure, sponsor of the show, fell 4%. The IVV ETF from iShares fell only 0.3%. And the difference between those two falling is that the NASDAQ ETF has a lot more tech stocks and they're a lot more like growthy type companies. those are still included in the IVV ETF, but it's 500 companies, not 100. Now, if we go to the Australian market, Australian shares are down over the month, but over the year, still positive, especially if you include dividends, it's up around 5%. Now, here's where it gets interesting. The Hang Seng Index, which for those of you that don't know, is one of these market trackers that are in emerging markets, so in Asia. The Hang Seng Index fell, by my data, 5%. And so what that means is that even though these other markets are going up, and this ties into what we spoke about at the very top of the show about emerging markets, even though these other markets are going up or not falling as much, this one is much more wild and swinging up and swinging down. And that's, in effect, what you would expect to happen with interest rates doing what they do and with uncertainty. Typically, if you're an investor, what's the first thing that you sell when you're freaking out? You sell the thing that you know the least about, and that is the riskiest. And you're like, oh, what the heck is that ETF doing in my portfolio? I'll sell that one or that stock. So that's typically what happens. And it happens with big investors as well. So that's why those types of investments tend to be more risky. Over the last month, bond ETFs, IAF, VBND, the two most popular, both positive. Over the year, both positive. So you might remember, Kate, at the start of the year, we were talking about these ETFs and why it's important to include bonds in your portfolio. And everyone was like, oh, why do you include bonds in your portfolio? I'm a growth investor. I don't want to put that in my portfolio. Look how bad they've been over the last 5 years. That's not how it works. So the fact that these bond ETFs went up when the shares went down is perfect diversification. It's diversification in action. Because if you wanted to, we haven't done this, but if you wanted to, you could sell now some of the bonds that have gone up and buy some of the shares that have gone down. And so you get a better deal. And that is the power of diversification. Now, when stocks are doing really well, you feel like you're getting left behind. But when stocks start doing really bad, you feel like a champion because you're like, hey, I've got these boring things in my portfolio. They keep going up. If we move to gold, gold has been really positive over the past month, and that's enough to make it positive over the year. The Bitcoin is up 33% over the year, but fell 10% in 1 month. And that's because, again, it's the riskiest thing in most people's portfolios, so they're quick to sell it. The final thing that I'll mention, and this is where we tie it back to the inflation thing that we said before, Kate, is when you approach the bank to get a mortgage, or if you approach the bank to get a term deposit of like 1, 3, 5 years, whatever the case may be, what is actually happening behind the scenes is the bank is taking a guess at what interest rates will be in the future. So if you go to the bank and you look for a term deposit, you might notice things if you check it today versus if you checked it a month ago. So if you go to the same ING bank page, which is what we did this month, and you look at the 1 year term deposit, last month that was 5.1% for a year if you had that term deposit for a year. This month, it's 5.05. So the difference between last month and this month is basically what we were talking about. ING has looked at what maybe is happening with inflation and gone, we shouldn't offer 5.1 because interest rates might not be that high in a year. Let's offer 5.05. That might be more reflective of what we see in a year. And that's economics in action. And that's how it affects your life. And the same thing with your mortgage. You might have gone to the bank last month and tried to get a fixed loan and then gone this month and got a slightly better deal simply because you waited a month and this new data came out in the economy. And that is how economics impacts your life. And I hope does that make sense?
Yeah, and it's probably pretty good timing to talk about this because on Monday's episode coming up, we're going through all of the top savings accounts and term deposits at the moment, and we're going to review some of the rates because often if you haven't looked at it for 6 months because life happens, things can run away from you and suddenly you're not in a great account for saving, you're not in a great term deposit. So we're going to have a look at some of those rates as well to make sure you're on top of what you could be getting if you are saving up for something or you're storing your emergency fund at the moment.
Good point. Really good point. I just wanted to call out, I did mention that I would talk about our portfolio. So we did make one change throughout the month. There is a YouTube video. It's called June
We'll find it and put it in the
Yeah,
show
it's in the
notes.
show notes, but it's for our June quarterly update for Rask Invest. So you can go and check that out on the YouTube channel. And I show you the full portfolio that we have that people pay for, and you can see it, and you can see the changes that we've made and why. But yeah, over the past month, the Rask Jupiter strategy for the month of July was up 2%, which is great news for our investors, because through all this stuff, it's held pretty firm. And I just want to reiterate this point to investors that listen to this. If you're a long-term investor in anything, typically all the data shows that a good long-term return from a diversified portfolio might be something between 7% and, say, at the very upper end, 10 or 11%. So somewhere in that range, right? That's it. Now, if you look at your portfolio every month, we don't need to do the crazy math here to know that it's about 0.5 to 1% if you average it out. That's not going to get your heart racing. It's not going to make you excited. But over the long term, that is what's powerful. And so if you look down at your portfolio for the past month, let's say you use Navexa or ShareSite or something to track your portfolio, and you go, oh, it went up 1%. You're not going to go and tell your friends about it. But that's actually good. So when you see these numbers, when you hear these numbers, just have the expectations that from a good diversified portfolio, that's what you could expect.
And long-term wealth creation isn't really that exciting in the moment. It's all these small incremental bits that over the long term, suddenly you've created wealth that will change you and your family's life.
Yeah, someone once said to me, Kate, that they don't invest in ETFs because it's kind of like watching the grass grow. I'm like, what are you talking about?
I've seen quite a few comments before on YouTube or at events where people are saying, well, ETFs are just so boring. And the thing is, that's the point. And that's good because you can worry about the rest of your life. You can build something that can work, that can build wealth for you without having to monitor it every day because, oh no, the company said something really bad and now there's a media storm and I've got to stay on top of what's going on.
Yeah. And Mitch actually, this is not planned at all, but Mitch put a comment. He put a post out in the Rask community, the free Rask community, saying, does investing have to be fun? And now for a lot of us, it probably does need to be fun because we enjoy it. And sure, you can do that. You can have your individual shares or a thematic ETF in your satellite. But for the core of your portfolio, keep it simple, keep it low cost, keep it diversified. Even if holding some bonds seems boring, even if having some cash seems boring, you can then eventually use that to top up the more exciting stuff in the future when those exciting things inevitably do hit a speed bump. But that's really it for this month, Kate. I know if you're interested in investing with us, you can get in contact with Mitchell, who's our head of funds management. You can book a call with him, or you can attend the Monday live show that he does. He shows you the full portfolio, and he also does one educational thing. It's only on YouTube. It's every Monday at midday, and you get heaps of nuggets. You get to see the ETFs. You get to ask questions live. So go and check that out. We'll put a link in the show notes. Other than that, Kate, what else is there?
I think you've covered most of it, Owen, but if anyone has questions for our next market update, wondering what on earth is going on about the economy, or if you want to learn about one particular market specifically, let us know. There's a link to ask a question in your podcast player or on the show notes website as well.
Yeah, that's definitely the best way to do it. We get a lot of feedback on Spotify, but definitely if you can use that link that says ask a question, we get hundreds of questions. And if we can see them all in one place, it does make our life so much easier, and we can put it all into the content blender and see what pops out the other side. So definitely do that. I did promise an action point to take away, which I'll leave people with, is that don't overcomplicate your investing or how you manage your money. We've talked a lot about complicated things like emerging markets, different types of ETFs, all that crazy stuff, inflation. If you've got to the end, just do what makes you feel in control, because that will be the best thing for you in the long term. It's your money. You need to manage it, and it's your future. So that's okay. If you leave some on the table, if you don't invest in this or you don't invest in that, that's okay. It's okay. Just make sure to maximize your sleep. I think that's really important, Kate. So that's it.
Often overlooked in finance, maximizing your ability to sleep at night with what you've done with your money.
The sleep strategy. If you have any thoughts on that, let us know in the community. I'd love to hear about it. But Kate, this has been heaps of fun. I love these market updates. So thanks for joining me.
No worries. Thanks for listening, everyone.
Thanks for watching this video on the Rask Network.
While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.